Something bizarre is happening in the skies above America. About 7 years ago, US low-cost carriers were raking in substantial record-breaking profits. All those infamous airlines known for their low prices and passenger scuffles were surprisingly printing money. Around 2015, JetBlue, for instance, pocketed 20 cents in operating profit for every dollar of revenue. Spirit Airlines achieved an impressive 24 cents, and Allegiant Air soared to a colossal 30 cents per dollar. At first glance, these profit margins might not seem groundbreaking, yet in the airline industry, they were monumental, record-setting figures that reshaped expectations for profitability. But things changed dramatically following 2019. This here is Spirit Airlines stock, and it doesn't take an expert to realize that they are in serious trouble. So what changed? How did carriers offering the lowest fares yield the highest profits in the past? In 2015, for example, legacy carrier United achieved a respectable operating profit margin of 13%. But budget airline Spirit, with its ultra-low-cost model, nearly doubled that, reaching an impressive 24% margin in the same period. So what exactly happened that sent Spirit Airlines stock crashing from $82 to just $2 in under a decade? A 97% plunge. That now has many speculating about the airline's potential bankruptcy. This answer may shock you. To start, let's consider the single biggest disruptor to hit the airline industry in over 50 years. When this grounded flights worldwide, airlines took a devastating hit. But for budget airlines like Spirit, which operate on razor-thin margins and depend heavily on filling as many seats as possible, the shock was particularly harsh. But despite these overwhelming challenges, there's more to Spirit's story than meets the eye. You can't just blame the pandemic. For instance, passenger volumes. In the years following the pandemic-induced meltdown, air travel in the US has not only rebounded but surged past previous records. Passenger numbers have fully recovered, and following this past summer, we're seeing unprecedented activity in the skies, with more people flying than ever before. But for budget airlines like Spirit, high passenger volumes should be a recipe for success. After all, these airlines thrive on maximizing seat occupancy and operating at razor-thin costs, so more travelers should translate directly into more revenue. Yet something puzzling is unfolding in America's skies. While legacy carriers, which also faced steep losses during the pandemic, have managed to rebound in line with surging demand, budget airlines, despite a brief post-pandemic recovery, are watching their financial stability crumble. This paradox is striking. Americans have never been more eager to fly, yet the very airlines offering the cheapest fares, theoretically the most appealing options for budget-conscious travelers, are faltering. With the skies busier than ever, why are low-cost airlines like Spirit buckling under pressure without any obvious reason? In fact, the entire low-cost sector seems to be going under. Spirit Air, along with Allegiant and Frontier, are all publicly traded companies, meaning they're required to disclose their performance to shareholders. Naturally, these shareholders are questioning why Spirit can't replicate its past successes. Now, if we look through their latest earnings reports, Spirit attributes its current struggles to a range of factors: increased competition, severe weather, engine reliability issues, and even civil unrest in countries like Haiti. While these are all legitimate challenges, they don't fully account for the near total collapse of Spirit's stock price. After all, other budget airlines face similar obstacles but have managed to bounce back, sort of. Consider Allegiant, a smaller airline with a fleet nearly half the size of Spirit's. Allegiant's stock has surged by 85% since August alone, indicating that profitability is still achievable even in a challenging environment. While Allegiant stock still remains 70% below its 2015 high, the company appears to be on a promising recovery path. Now, to put Spirit's struggles into perspective, in Q2 of 2023, Spirit generated about $1.4 billion in revenue but managed only a 1.4% profit margin. While that's already slim, the situation has actually worsened dramatically this year. In Q2 of 2024, Spirit not only brought in about 10% less revenue compared to the previous year, but also posted an operating margin of negative 11%. This means that despite billions in revenue, Spirit is operating at a loss. This decline comes at a critical moment. Spirit faces heavy debt loads and intense competition, and without a turnaround, bankruptcy could be on the horizon as it struggles to recover from post-pandemic challenges. Meanwhile, Allegiant, though also seeing a slight revenue decline, achieved an impressive 8% operating margin. showing it's not only surviving but steadily navigating its way to profitability. But at the end of the day, all of these budget airlines face a similar fate. While a few smaller, more agile carriers might navigate the market and scrape by, the larger players, even those once seen as invincible, will all encounter similar challenges in the low-cost space. And it all comes down to one factor that nobody seems to be talking about. Now, before diving into why I believe budget flying as we know it is facing an inevitable decline, let's hear a professional take on the subject. Here's a clip from the Schwab Network where industry analyst George Tillis shares his reaction to Spirit Airlines and explains why he believes they may be heading towards bankruptcy very soon.
Joining us now is George Tillis, senior markets correspondent for the Schwab Network. George, it's been quite the fall for Spirit. So much was hinging on its potential, merger or takeover from one of its peers. Because those at least have been, falling through from a regulatory standpoint and other reasons, it's been a pretty dismal run for the better part of the last few years. What do we make of the current situation, George?
Well, I think this is an example of how a cheap stock can get even cheaper. And ideally speaking, the value of this stock, assuming they do file for chapter bankruptcy, they'll either go through a liquidation or a reorganization. Common equity shareholders are going to get wiped out. The stock will go to zero. Even if Spirit does come out as a reorganized business and they do issue new equity, and that's after they've settled with their major debt holders or their bond holders, new stock could be issued, but it won't be the same stock as what's chartered now under its going concern or corporation as it goes into bankruptcy. So I think if you consider what's going on with this business, one, I just went back and looked at 2019 levels, and the company was actually, had about $3.8 billion in sales. And if you look at the last 4 quarters or last year, sales were higher by about 39%. To $5.6 billion. But the challenge is back in 2019, when they were much smaller in terms of size and scale, they were making money over $4 a share. And that's when the stock was trading around $44. Fast forward to the last 4 quarters or last year, they lost $4.89. So they basically, more than doubled their losses compared to profits to 5 years ago. So I suggest what's happened here with Save is essentially the pandemic really hurt this business. They couldn't recover. They've been issuing equity, increasing capacity, by the way, but their cost of that increased capacity essentially exceeded the growth in sales that the company has generated since that.
As George just pointed out, the issue for Spirit and other budget airlines isn't a lack of passengers. In fact, capacity and revenue have both increased, with more people flying Spirit and spending more than ever, padding the airline's revenue. Back in 2015, when Spirit stock was at its peak, the airline operated just 79 planes. Fast forward 9 years, and that number has grown to around 212. This isn't a popularity problem, it's a scaling issue. Take Spirit's A320, configured with 182 seats. A round-trip flight from New York to Los Angeles burns around 48 gallons of jet fuel. In 2016, when fuel was at a low of $1.10 per gallon, the fuel cost per passenger for that flight was around $29 round-trip. But as recently as last year, jet fuel hit $3.12 per gallon, pushing the per-passenger fuel cost to $82, nearly 3 times higher. And remember, that's just fuel. This is a hypothetical flight, but remember, there are hundreds of other expenses involved in running an airline. Pilot and crew wages, maintenance, aircraft leases, runway fees, the list goes on and on. Now think about what you paid for your last Spirit flight and do the math. It's very hard to break even in this industry, especially when fuel costs are this high. And sure, you can somewhat get away with running this type of airline when fuel prices do this, but the second they move up, a company that is working at scale just doesn't have the pricing power to compete with the legacy carriers. This is especially true when the budget airlines grow to the size of Spirit. Not only are they facing this expense crisis, but they face adaptability issues, being unable to quickly adapt to new trends, routes, and problems. When your margins are that thin, there is not a lot of room for error. And while smaller companies like Allegiant can somewhat do a better job than Spirit, all the low-cost carriers face this issue. And in my opinion, in an inflationary world where commodity prices can rapidly change due to all kinds of factors, all of them are doomed to fail in a world where oil and in turn jet fuel can spike overnight. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it. And don't forget to let me know in the comments what you think of the legacy versus budget debate.